Did you know that 90% of investors lose money in the stock market? Shocking, right? But there's a way to change that. Imagine using ancient war strategies to conquer the financial markets. Sounds intriguing? Sun Tzu's The Art of War isn't just for generals, it's a goldmine for investors too. Let's dive into the unexpected world where military genius meets market mastery. We'll reveal how you can use timeless strategies to make smart investments. From mastering market tactics to leveraging your strengths, we've got it all covered. Want to know how to surprise the market with unconventional moves or how to build powerful alliances? You're in the right place. Stay tuned as we unpack 12 actionable tips from The Art of War that can transform your investment game. Ready to become a financial warrior? Let's get started. Chapter 1. The Power of Strategy, Mastering Market Tactics. In investing, strategy is everything. Just like in The Art of War, a well-planned strategy can mean the difference between success and failure. Sun Tzu said, "Victorious warriors win first and then go to war, while defeated warriors go to war first and then seek to win." This is a powerful reminder that preparation is key. A good strategy starts with understanding the market. Did you know that only 10% of investors consistently outperform the market? This is because they have a clear strategy. For example, Warren Buffett's value investing strategy focuses on buying undervalued stocks and holding them long-term. His approach has made him one of the richest people in the world. Strategic planning involves setting clear goals. What do you want to achieve with your investments? Are you looking for long-term growth or short-term gains? Once you know your goals, you can develop a strategy to reach them. Another critical aspect is market analysis. This means studying market trends, economic indicators, and company performance. For instance, during the 2008 financial crisis, those who analyzed market conditions and adjusted their strategies accordingly managed to protect their investments better. Your strategy should also include risk management. This involves diversifying your portfolio to spread risk. According to a study by Vanguard, a well-diversified portfolio can reduce risk by up to 30%. This is why it's essential to have a mix of different asset classes, such as stocks, bonds, and real estate. Chapter 2. Know yourself, know your investments. Sun Tzu famously said, "If you know the enemy and know yourself, you need not fear the result of 100 battles." In investing, knowing yourself is just as important as knowing the market. This means understanding your risk tolerance, investment goals, and financial situation. Risk tolerance varies from person to person. Some people are comfortable with high-risk, high-reward investments, while others prefer safer, more stable options. A survey by Riskalyze found that 52% of investors are risk-averse, preferring stability over high returns. Knowing your risk tolerance will help you make better investment choices. Your investment goals are another crucial factor. Are you saving for retirement, a down payment on a house, or your child's education? Each goal will require a different investment strategy. For example, if you're saving for retirement, you might focus on long-term growth investments like stocks or mutual funds. Understanding your financial situation is also vital. How much can you afford to invest? Do you have an emergency fund? Financial advisors often recommend having at least 6 months' worth of expenses saved in an emergency fund before you start investing. This ensures you won't have to sell investments at a loss if you need cash quickly. Chapter 3. The Art of Deception, Market Maneuvers. Sun Tzu's teachings on deception can be surprisingly applicable to investing. He said, "All warfare is based on deception." In the investment world, this means understanding and leveraging market psychology. Market maneuvers involve taking advantage of market trends and investor behavior. For example, during a market downturn, many investors panic and sell their stocks. However, this can be a great time to buy. Warren Buffett once said, "Be fearful when others are greedy and greedy when others are fearful." This strategy of contrarian investing has proven successful for many. Deception also involves understanding the signals you send to the market. For instance, large institutional investors often make trades that signal their confidence in a particular stock, influencing other investors to follow suit. A study by the National Bureau of Economic Research found that stocks bought by institutional investors tend to outperform the market by an average of 1.8% over the following year. Moreover, being able to see through market hype is crucial. Not every hot stock or trending investment will be profitable. Remember the dot-com bubble of the late 1990s? Many investors were lured by the promise of massive returns, only to see their investments crash when the bubble burst. Understanding the fundamentals of a company, rather than getting caught up in hype, can save you from significant losses. Chapter 4. Winning without fighting, passive income streams. Sun Tzu believed in winning battles without fighting. In investing, this translates to generating passive income. Passive income means earning money without actively working for it, which is an effective way to build wealth over time. One of the most popular forms of passive income is dividends. Companies like Coca-Cola and Johnson & Johnson have consistently paid dividends for decades. According to a study by Hartford Funds, reinvested dividends have contributed 41% of the S&P 500's total return since 1930. Real estate is another excellent source of passive income. Rental properties can provide a steady cash flow with relatively little effort once set up. A report by the National Council of Real Estate Investment Fiduciaries found that private real estate investments have an average annual return of 9.85%. Peer-to-peer lending is a newer form of passive income. Platforms like Lending Club allow you to lend money to individuals or small businesses in exchange for interest payments. This can provide higher returns than traditional savings accounts or bonds. Lastly, consider investing in index funds. These funds track the performance of a specific market index, like the S&P 500, and require minimal management. Vanguard's S&P 500 index fund has an average annual return of about 10% since its inception. Investing in passive income streams allows you to grow your wealth with minimal effort, aligning perfectly with Sun Tzu's philosophy of winning without fighting. Chapter 5. The element of surprise, unconventional investment moves. Sun Tzu emphasized the power of surprise in warfare, and the same principle can apply to investing. He said, engage people with what they expect. It is what they are able to discern and confirms their projections. It settles them into predictable patterns of response, occupying their minds while you wait for the extraordinary moment, that which they cannot anticipate. In investing, unconventional moves can yield significant rewards. For example, consider the rise of cryptocurrencies. When Bitcoin first emerged, many investors were skeptical. However, those who recognized its potential early on reaped substantial profits. As of 2021, Bitcoin's value had increased over 300,000% since its inception. Another unconventional move is investing in emerging markets. These markets often come with higher risks but can offer higher rewards. For instance, over the past decade, countries like China and India have shown impressive economic growth, providing substantial returns for investors willing to take the plunge. Investing in startups is another strategy that can pay off. While many startups fail, those that succeed can provide enormous returns. For example, early investors in companies like Uber and Airbnb saw their investments grow exponentially as these companies expanded globally. Sustainable and socially responsible investing is also gaining traction. A study by Morgan Stanley found that sustainable investments often match or exceed the returns of traditional investments. As more consumers and companies prioritize sustainability, this trend is likely to continue. Chapter 6. Know the terrain, market research and analysis. Sun Tzu advised, know the enemy and know yourself. In 100 battles, you will never be in peril. For investors, knowing the terrain means conducting thorough market research and analysis. This helps you understand market conditions and make informed decisions. Start with fundamental analysis, which involves evaluating a company's financial health. This includes examining financial statements, earnings reports, and key ratios like the price-to-earnings (P/E) ratio. A lower P/E ratio can indicate that a stock is undervalued. Technical analysis is another essential tool. This involves studying price charts and patterns to predict future market movements. Many successful traders use technical analysis to identify trends and make timely trades. For instance, the Relative Strength Index (RSI) can help determine if a stock is overbought or oversold. Macroeconomic factors also play a crucial role. Understanding economic indicators such as GDP growth, inflation rates, and employment statistics can provide valuable insights into market trends. For example, during periods of economic growth, stock markets tend to perform better. Using research tools like Bloomberg, Morningstar, and Yahoo Finance can help you stay informed. These platforms offer a wealth of data and analysis, making it easier to track market trends and company performance. Staying updated on industry news and events can also give you a competitive edge. Chapter 7. Adapting to change, flexible investment strategies. Sun Tzu believed in the importance of flexibility, stating, "In the midst of chaos, there is also opportunity." In the investing world, being adaptable can help you navigate changing market conditions and capitalize on new opportunities. One way to stay flexible is by diversifying your portfolio. Diversification spreads risk across different asset classes, industries, and geographies. A well-diversified portfolio can protect against market volatility. According to a study by Fidelity, diversification can reduce risk by up to 30%. Rebalancing your portfolio is another key strategy. This involves periodically adjusting your investments to maintain your desired asset allocation. For example, if stocks perform well and become a larger part of your portfolio, you might sell some stocks and buy bonds to restore balance. Keeping an eye on market trends and being willing to adjust your strategy is crucial. For instance, during the COVID-19 pandemic, many investors shifted their focus to tech stocks, which outperformed other sectors. Adapting to such trends can help you stay ahead. Staying informed about economic and geopolitical events is also important. Events like elections, trade agreements, and natural disasters can impact markets. Being aware of these factors allows you to make proactive adjustments to your investment strategy. Chapter 8. Leveraging Strengths, Maximizing Your Investment Potential. Sun Tzu advised, use your opponent's strengths against them. In investing, this means leveraging your strengths to maximize your investment potential. Knowing your strengths can help you make smarter investment decisions and achieve better results. Start by identifying your investment strengths. Are you good at analyzing financial data? Do you have a knack for spotting emerging trends? Knowing your strengths can help you focus on areas where you are most likely to succeed. Leveraging strengths also means building on your knowledge and skills. For example, if you have a background in technology, consider investing in tech stocks. Your expertise can give you an edge in identifying promising companies and technologies. Using tools and resources to enhance your strengths is also important. Financial news websites, research reports, and investment apps can provide valuable insights and help you stay informed. Platforms like Seeking Alpha and Motley Fool offer expert analysis and recommendations that can complement your own research. Networking with other investors and financial professionals can also help. Sharing insights and strategies with others can provide new perspectives and ideas. Joining investment clubs or online forums can be a great way to connect with like-minded individuals. Chapter 9. The Cost of War, Risk Management. Sun Tzu emphasized understanding the cost of war. In investing, this translates to risk management. He who wishes to fight must first count the cost, Sun Tzu wrote. Knowing your risks can save you from financial ruin. Risk management starts with diversification. Spreading your investments across different asset classes reduces the impact of any single loss. According to a study by Vanguard, diversification can lower risk by up to 30%. Using stop-loss orders is another smart strategy. This helps you limit potential losses by setting a predetermined sell price. For example, if you buy a stock at $50 and set a stop-loss at $45, your stock will automatically sell if it drops to $45. Having an emergency fund is crucial. Financial advisors suggest having at least 6 months' worth of living expenses saved. This ensures you won't need to sell investments during market downturns. Understanding your investment timeline is also key. Longer time horizons allow for more aggressive strategies, while shorter ones require more conservative approaches. For instance, if you're nearing retirement, you might shift from stocks to bonds to preserve capital. Insurance is another form of risk management. Life, health, and property insurance protect your assets against unexpected events. This can be especially important for business owners and real estate investors. Chapter 10. Timing the Battle, Market Entry and Exit Strategies. Sun Tzu believed in the importance of timing. Attack when they are unprepared, he advised. In investing, this means knowing when to buy and sell. Market entry strategies start with research. Look for undervalued stocks or assets. For instance, during market downturns, many quality stocks are available at a discount. Warren Buffett famously said, "Opportunities come infrequently. When it rains gold, put out the bucket, not the thimble." Using dollar cost averaging can also be effective. This involves investing a fixed amount of money at regular intervals, regardless of market conditions. Over time, this can reduce the impact of market volatility. Exit strategies are equally important. Knowing when to sell can maximize your returns and minimize losses. One approach is to set target prices for selling. If a stock reaches your target, you sell and lock in your profits. Trailing stop orders can help protect gains. Unlike a regular stop loss, A trailing stop moves with the market price. For example, if your stock rises, the stop loss level rises too, protecting your gains while limiting losses. Paying attention to economic indicators can also guide your timing. For instance, if interest rates are expected to rise, it might be a good time to sell bonds, as their prices typically fall when rates go up.